In today's episode, I'll talk about two interesting stories. In the first story of the day, I'll talk about the insights that all of us can take away from the latest US Federal Reserve meetup and what it means for all of us. And in the second story of the day, I'll break down a new paper that the RBI has released on what is called remittances. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Friday, the 21st of March. See, the US Federal Reserve recently had a meeting. Now, at the very surface of it, this was a meeting where absolutely nothing happened because, after all, the Fed kept interest rates exactly where they were. But the thing is, even though it looked like nothing changed on the surface, the actual announcement and the conversation around it contained a lot of important details that you and I need to note down. See, for your quick context, the Fed had previously cut interest rates by a total of 1% towards the end of last year, and then once the new president came into office, the Fed effectively froze interest rates. So interest rates have been steady since then, even though some people, including the US president, seem to think that it is time to move to a different direction. Now, if you dig into the Fed's projections, you will see that on an average, they expect to lower interest rates twice in 2025, and each cut would be likely a quarter of a percentage point. And this expectation is shown in what Fed calls the dot plot, where each member of the Federal Open Market Committee marks where they believe rates will end up. But if you look a little closely, there is actually a lot of disagreement. Out of 19 committee members, 9 want to stick with 2 quarter point cuts, 4 only see 1 cut, 4 do not see any cuts at all, and 2 want to cut rates 3 times. Now that is a wide range of opinions, and it also tells us that the Fed is not really marching in the perfect lockstep right now. During the press conference, Jerome Powell, who chairs the Fed, said that they are in no rush to make moves. He used phrases like "we are well positioned to wait for further clarity," which basically means that the Fed wants to see more economic data before they decide whether to raise or lower interest rates. Now, in practice, this could mean that we will not see rates go down until around the third quarter of this year, and maybe even later if the economy does not really cooperate. Now, this careful stance stands in contrast to the views of the current president, who publicly called for rates to drop immediately. Now, Powell, when he was asked about these particular remarks, declined to comment on them directly, but also made it very clear that the Fed makes decisions independently and they will do what it thinks is best for the broader economy. Now, along with the rates decision itself, the Fed also published forecasts about where the economy might be headed in the future. Now, these forecasts were not very reassuring, to be honest. The Fed significantly lowered its estimate of how fast the US economy would grow this year, and it also raised its estimate for how much inflation there would be. Growth is now expected to be around 1.7% this year, which is down from about 2.1% in the previous forecast. The Fed also trimmed its projections for future years, where they're expecting growth of only about 1.8% in 2026, down from 2%, and 1.8% in 2027, down from 1.9%. At the very same time, the Fed raised its core PCE inflation estimate of this year from 2.5% to 2.8%. Rising inflation alongside falling growth is an uncomfortable combination. Economists often worry about stagflation, which is basically when growth is slow or flat while prices keep climbing up. Now, nobody's really saying that we are heading straight for the 1970s stagflation repeat, but the comparison sometimes comes up when you see inflation and growth moved in the wrong directions at the same time. The Fed also believes that unemployment rates could inch up to about 4.4%, and that would be relatively low by historical standards, but it is still higher than what it used to project. Now, a part of the reason for these adjustments is that the Fed sees a lot of uncertainty in areas like government spending, tariffs, and immigration policy. Tariffs, which are basically taxes on imported goods, can make things more expensive for consumers and potentially hurt company profits if the companies have to absorb the higher costs themselves. Government spending can also affect the economy if big cuts or expansions can happen too quickly, and changes in immigration might impact the size of the labor force. Now, Jerome Powell admitted that nobody nobody is really confident in their forecast right now, which reflects how many different factors are swirling around currently. One more issue that came up in this meeting is called quantitative tightening. See, since about a year now, the Fed has been shrinking its massive balance sheet. And when the Fed shrinks its balance sheets, it basically allows some of the bonds that it holds to mature without really replacing them, and that effectively removes money from the banking system. Now, this can also slow down the economy if it's done aggressively because banks have fewer reserves and they become more and more cautious about lending. Previously, the US Fed had a monthly limit of about 25 billion US dollars for how much of its treasury holdings it would let run off. But now it is cutting that limit way down to $5 billion per month, though it will keep its monthly redemption cap for mortgage-backed securities at $35 million. Now, this might sound a little technical to you at once, but it basically means that the Fed is not going to pull money out of the system as quickly as it was once planning to because they are worried about causing sudden liquidity problems for banks, exactly like what happened in September 2019 when short-term lending markets got very shaky. Now, these liquidity issues could become even more complicated because of the United States debt ceiling. See, the US Treasury cannot really borrow beyond a certain limit without congressional approval. And right now, it is up against that limit, which basically means that it cannot issue new debt. Instead, the Treasury has been using funds from its own accounts at the Fed called the Treasury General Account in order to cover government expenses. And as it does this, the money flows into the banking system. But when Congress eventually raises the debt ceiling, the Treasury will have to very quickly replenish its account, pulling all of that money right back out. And if the Fed were also removing money from the system at the same time, there could potentially be a risk that interest rates in overnight lending markets could suddenly jump up, much like what they did in 2019, like I said. Now, that was a big shock back then, so the Fed now wants to avoid a repeat by slowing down its balance sheet runoff. Roberto Perli, who's a Fed official who helps oversee the balance sheet process, said that this slowdown is more of a tactical decision than a change in the Fed's longer-term goal, which is still to reduce the overall size of its holdings. The idea here is basically to do it carefully and not accidentally cause any nasty surprises that could sort of ripple through the entire financial markets of the world. So now, putting all of these pieces together for you, the Fed's overall stance is one of caution for sure. It is facing a wide range of unknowns, from tariffs that could push prices higher to immigration shifts that might affect how many people are available for work, to even government debt issues that influence how much cash flows in and out of the banking system. The Fed's new forecast suggests that the economy might face slower growth and higher inflation, which is not really an ideal mix, to be honest. And while Powell stressed that the economy and job situations remain solid, the data the Fed itself released paints a picture of a potential slowdown on the horizon. For everyday people and investors like you and I, this means that we should not really expect sudden changes in interest rates until the Fed really feels more certain about how everything will play out. Now, they would rather keep interest rates steady and slow down their balance sheet reduction than make a hasty move that could backfire in a big way. With that, let's move on to the second story of the day and talk about a recent paper that the Reserve Bank of India came up with, which is on something called remittances. Now, in case you're new to the word remittances, for your very quick context, these are sums of money that people send back home when they're working abroad. Now, at the very first glance, I know this may seem like a very routine financial detail to you, but the thing is, once you look just a little closer, you will see how massive and important these flows are for India. See, in one single year, India received around $118 billion in such inflows, which is more than double what it was about a decade ago. Now, this is not just a large amount, mind you. It is enormous enough to rival other big economic forces like foreign direct investment, which is basically where outside companies invest in Indian factories or businesses. It also dwarfs any foreign aid that goes straight into people's hands without passing through large government programs, which basically means it is relatively free from corruption and cuts. Remittances matter because they give our economy a kind of stability that it might not otherwise have. You can think of them as shock absorbers of sorts for Indians' finances. Our country depends on importing many things like oil, fertilizers, and even military equipment. So we often run what is called a trade deficit, which means we buy more from abroad than what we sell. Now, money that is sent home by workers who are working abroad can cover around 42% of that very gap, which is absolutely massive. And when foreign investors pull back, or if there is a global financial crisis, we can still rely on people sending money back home. And this is one of the many reasons why we don't see small problems really spiraling into much bigger national crisis. Over the last 15 years or so, India has consistently been the largest recipient of remittances in the entire world. Since 2008, no other country has received as much money from its workers abroad as much as we have. To give you quick context, about 14% of the global remittances make their way to India. As of 2024, 6% of all international migrants on the planet came from India, and the Reserve Bank of India thinks that these numbers could rise a lot more in the near future. By 2029, we might be looking as much as 160 billion US dollars flowing in every single year. And one reason is our growing population of working age people who may want to seek opportunities outside India's borders, particularly if the local economy cannot fully absorb them just yet. But we're not just talking about the same type of migrant workers that we saw in the earlier years. Historically, a large share of India's remittance incomes come from blue-collar workers in the Gulf countries, which are places like United Arab Emirates, Saudi Arabia, and Kuwait. Now, many of these workers do construction jobs, hospitality work, or domestic labor. Even though the Gulf is still very significant and accounts for about 38% of our remittances, there has been a big shift in the recent years. More than half of the total remittances that are coming into India now originate in advanced economies like the United States, the United Kingdom, Singapore, Canada, and Australia. The US alone contributes nearly 28% of our total remittances, up from just over 23% a few years ago. And this change is partly because more Indians are now highly skilled and are working in high-paying fields like technology, business, banking, or science. Just one software engineer in California or one investment banker in London might actually end up sending home as much money as 10 construction workers in the Gulf. Government policies also help a big way here. In 2021, India and the UK signed a migration and mobility partnership deal, which basically made it easier for Indians to go to the UK. And within just 3 years, the number of Indians who moved to the UK every single year jumped from about 76,000 to 250,000 people. And that showed up in our remittance numbers as well. The share of India's remittance money coming from the UK rose from about 7% to nearly 11%. But despite all of this, the Gulf remains a major destination for Indian workers. Countries in that region still employ many of our people, and the United Arab Emirates remains our second biggest source of remittances at around 19%. But that said, because of oil price fluctuations, policy changes, and sudden layoffs, workers in the Gulf can face a lot more uncertainty. Also, during the COVID-19 pandemic, for instance, India saw a big drop in remittances from the Gulf. But on the other hand, jobs in Western countries tend to be a lot more stable, so they offer a steadier flow of money back home. And that means our remittance inflows are becoming more robust over time as more and more people look for highly skilled jobs in places like the US and the UK. But there is a nagging issue here. There are high transaction costs. See, sending money across international borders is usually very expensive than it otherwise should be. The United Nations wants these fees to be capped at 3% of the total amount, but globally speaking, the costs currently average around 6.5%. India does a little bit better where we hover around 5%, but that is still well above the ideal threshold of about 3%. What's even worse is that smaller amounts, which is under 200 US dollars, tend to get hit with higher fees. So the very people who might be earning the least and sending money home in small chunks end up paying the most money in charges. Some of these fees come from old-fashioned bank transfers using systems like SWIFT, where costs can sometimes reach nearly 12% for small transactions. Newer fintech-based methods linked to systems like the rupee drawing arrangement can basically bring costs down to around 1% for large transfers. And all of this leads to a very clear takeaway for us. If India can really harness the digital infrastructure to reduce the cost of sending money, more of every hard-earned dollar will reach families to India. Linking India's UPI network with global payment systems such as Singapore's PayNow is one example of these efforts. But still, the challenge lies in ensuring that these benefits really reach the people who need smaller sums because they need every possible rupee to reach home. Finally, there is a deeper point in all of this. India's reliance on remittances reveals how important these money inflows are for keeping our economy stable. It is reassuring to know that they can cover a big chunk of our trade deficit, but at the very same time, it also underscores how dependent we can remain on people working abroad. Remittances buy us time and stability, but they aren't really a full substitute for building a more powerful and self-sustaining economy at home. So in a sense, India's role in the global economy has evolved into being a major exporter of talent, just as some countries are famous for exporting manufactured goods. And that brings us to the end of the two stories of the day. With that, let's move on to the final section and talk about the quick news headlines. First, Ultratech Cement, which is a part of the Aditya Birla Group, has increased its domestic production capacity to 178.86 million tons per annum or MTPA with an additional 1.2 MTPA through debottlenecking at its Hirmi Cement Works and Roorkee Cement Works. Second, the Union Cabinet has approved a 1,500 crore incentive to promote low-value BHIM UPI peer-to-merchant transactions in FY 2025, aiming to push total UPI volumes to 200 billion. This scheme offers a 0.15% incentive for transactions up to 2,000 rupees made to small merchants, while large merchants in the same bracket receive no incentive. Third and the final one for the day, state-owned issuers like NABARD and SIDBI raised 14,000 crore rupees through medium and short tenor bonds, shifting from their typical preference of long debt. NABARD secured 7,000 crore rupees via 3.5-year bonds at a coupon rate of 7.48%, while SIDBI raised 6,000 crore rupees through 5-year bonds at 7.39%. That's all the news and stories I have for you today. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.